calls or what. We're going to talk about Tesla in a second. Yes, let's move on to Tesla. But one thing we noted yesterday when we were talking is that the December 2025 calls for Tesla just came out. That's almost 3 years. That's pretty crazy when you think about it, because it's the end of March, so it's the end of December. That's 3 months. That's 2 years and 9 months. Is that right?
Yeah.
That's a lot of time to wait for Tesla, So that's a good thing. That's a good thing in time, like having time on your side, because who knows how long this macro bear market interest rate fluctuation is going to happen, which is, ridiculous already. Like that the Fed is still jawboning, keeping rates high. And, we all know they're going to lower rates later this year for recession. Recession's going to, it's like the futures are pricing it in. It's going to be like, I think the Fed futures 50-50 line last I saw was like 3.5% by the end of this year or something, that they're going to lower it to that point, something like that. So even though they're saying we're going to keep rates high for a long time, if you're a betting man, the odds makers, the market makers, the markets are the 50-50 over under is 3.5% end of this year, something like that. So we'll see what happens, I guess. But
on the 2025 thought too. I mean, you make a good point for the kind of macro market turning around at some point, but think about it just from the Tesla perspective as well. And we don't have a position in these, to be honest. I mean, obviously we're long Tesla via stock and call, so not investment advice, but just thinking of the next 2 years and 9 months, what's going to happen. Obviously you're going to have Cybertruck by then, you're going to have the Giga Mexico plant and the Gen 3 platform actually producing and selling by that time. I mean, you've got Tesla Energy ramping pretty significantly during that time, and look at all the improvements in AI in the last 2 years. Tesla obviously has been really slow on the improvements in FSD. But I think it's a huge mistake to look at how slow the developments over the last 3 years have been, and then extrapolate forward on that. I mean, this V11 was a huge, gargantuan undertaking, and I don't think they have another one of those massive structural software stack upgrades in the next 3 years. I think a lot of what they're going to be doing is just optimizing and fine tuning the the parameter weightings and everything like that to really make the software a lot better. So thinking on if it's drastically better 12 months from now, what does that do to take rates, and what does that do to the financials, and does autonomy happen in the next 2 years and 9 months? I think there's a good chance that could happen. So I don't know. It's like the macro looks really opportunistic. I think if you go out almost 3 years and Tesla's fundamentals too, it's just, there's so much to be excited about.
There is a lot. Yeah. I mean, the ramps of the Berlin and Austin. The only concern I have, I would say, the only potential risk I see really for Tesla, not only the macro market, interest rates staying high for longer, and, the market's got, going to just slowly dissipate, valuations are going to slowly get worse and worse, and because of interest rates are going to be 5%, 6% for a long time or something. The only thing I'd say is right now what's priced into Tesla stock at these current interest rate discount present value valuations is a lot of growth, right? And so we're witnessing the growth. I think that's sort of priced in, and that's why the stock isn't ramping up so fast, even though we're going to have a record quarter deliveries probably in Q1. Because to warrant this, $600 or $700 billion valuation we're at now, you really need to show this type of growth, to continue. And the Model 3 and Model Y, how do we know that if they're close or not to their saturation point? I mean, Model Y is the best-selling car in the world, right? It will be this year. But does that mean it can be double the best-selling car the 2 years later? I don't think so. I don't know. I mean, I think there's a limited saturation capacity for a $50,000 car, which essentially the Model Y is when you have some options. It's probably averages around 50,000. I'm guessing something like that, 45 maybe with rebates or something. So that's the only bearish point I would say is the Model Y might max out at 3 million units globally a year. Let's say, and the Model 3, let's say, is 500,000 units a year because it's just a sedan and it's not as popular, or 2.5 and 500. Maybe that all maxes out at 3 million. and you see that max out, you see the factories, you have to kind of wait for that Gen 3 platform then. And maybe the Gen 3 platform, even though we're all excited, the Mexico plant's going to be built in record time, these things get delayed. Maybe the Mexico plant is 2 years before it produces the first car. Then there's like a slow ramp. And, by that time, the stock might not have not appreciated yet, if everything takes a little bit longer than expected to play out. That's all I'm saying. Because when the Gen 3 platform is, I'm confident that when it does ramp up, that there will be a new valuation model on Tesla for building 10 million cars a year being more widely accepted, and selling. Right now, I think too many people are skeptical that Tesla will ever get to 10 million cars a year. That's what I think. So we'll see.
Yeah. Yeah, but I mean, like, so even if the Model Y and everything else is at 3, I think just thinking of how much bigger the demand for the Gen 3 platform would be, I think it should be at least double that. So call it 6. So then you get to
Yeah.
9 just on
Then you
those
get to
two, and
10,
maybe a
basically.
million from Cybertrucks. So then you get to 10, but that's basically like what Wall Street and I mean the Gary Blacks of the world are even thinking. So
Yeah.
to me, it's if Musk is right, and maybe I don't think the 20 million is probable, to be honest with you, by 2030. But if it's 15, that would definitely be like a net gain to the stock. But I think the more important thing from a valuation standpoint, I think, is going to be what do those margins look like?
Yeah.
Because the potential of autonomy and just like full self-driving to really drastically change the financial profile of the company. A lot of people talk about how that's already priced in, but it is not priced in. I don't think at all. So that's a huge upside that still remains there, I think.
Yeah. Yeah. What's not priced in yet? The compact car capacity, you mean? Or
Well, the improved margin potential from
oh,
autonomy. So like
oh yeah, yeah,
if
yeah, yeah, yeah.
FSD take
Higher
rate,
adoption rates and stuff.
yeah,
Yeah. Hmm.
it's so low right now. I mean, I think we'll go through the model in
Yeah.
a second, but I think I'm assuming a 6% take rate on FSD.
Yeah.
So it's just so small. But
Yeah.
if they get to 15, 20, 25%, I mean,
Yeah.
that's a lot of extra billions of dollars of margin that they're going to have.
Yeah. I see. Yeah. And T Nelly in the comments says Tesla needs to focus on concrete tangibles, get Cybertruck out ASAP, and full focus on solving the 4680 dry battery electrode. Yeah, I agree. Those things need to be. That's like the hard tech proof showing, like, hey, we're manufacturing experts or the leaders in the world. Look, we built this amazing Cybertruck. We're doing batteries like no one's ever done them. I think that just furthers the case for for such a high valuation, even amongst the bears like Drew Dixon,
Yeah.
and so I'm just thinking from his point of view, and people like him who aren't necessarily like shorting Tesla, but they're just bear and skeptics. And I think the majority of institutional Wall Street is kind of doesn't understand Tesla enough to really, and they're kind of just stay cautious about the valuation, thinking it's rich and maybe it's not, it's not worth investing in yet. And I think if you can get those people on board by showing them, like you said, the improved margins with the adoption rate of full self-driving picking up, and battery production, doubling year over year for Tesla because they solved the DBE, equation for that, and the Cybertruck ramp go fast. If you can show that type of stuff, I think the stock could be in for a nice upside surprise. And that's all very possible in the next 1 or 2 years. And so anyway, let's go on. We've talked a lot about this long-term 3-year out call option timeline. So the model, this is the big feature event for today. We're going to preview the model. We're going to estimate that. We sort of said in our prep call that we were going to maybe say a bullish realistic guess is 445. Maybe we can change it to 440. I'm thinking, what do you think? That seems to be like a more bullish / realistic guess to
Yeah.
me. Do you think we could do that in the model?
So we can do that, and I'll pull the model up here in a second for everyone. But just to give some background, Emmett and I were just kind of looking through the production and delivery figures, and one of the big surprises, I think, at least to you and I, was that the Giga Berlin plant was had reached 5,000 a week already, when they had just reached 3,000 in late December. So that those two data points give a pretty good idea that the average output over the course of the quarter is 4,000 a week. And so when you do that math, I think it was either 10 or 15,000 units higher than Troy's production figures just for that one plant. And then on top of that, Shanghai's looked relatively strong. The European inventory levels continue to go down. And so there's just a lot of signs pointing towards the kind of 420, 425 figures that we were looking at seem really low now that we're kind of seeing this end of quarter push. So I'll share the model now, and we can kind of talk through these different scenarios. We'll start with the base case here, and then we can kind of do a sensitivity after we walk through this. All right, so can you see the screen there?
I see it, and we'll talk through the key numbers for people listening on Twitter Spaces.
Yep.
Go on.
And just a quick note, as we're going through this model. So the last 2 quarters, with Berlin and Austin ramping up, we had this more detailed model that we had walked through in detail that kind of did the cost by plant and everything like that. But we also had the biggest misses by far in the history going back to 2019 since I've been doing these quarterly estimates. The updated model, which we were thinking would be a little bit more granular and a little more accurate, seemed to kind of result in a upward bias. So we missed high on earnings and margin by a pretty significant amount. So went back to basics, used this more simplified model that I've been using since 2019. So hopefully that gets us a little more accuracy than we've had for the past 2 quarters. But at a high level, we're starting with pricing, and I've assumed essentially a 7% price cut. So per Zach's comments, the kind of list price decrease that we saw Q4 to Q1 is not going to be realized. It's kind of the ASPs in Q4 were a lot lower than the list prices were indicating. And that means that the realized ASP in Q1 is not going to go down the full, 10, 15%. So we're assuming 7% decrease in ASP here.
So from 50,700 to 47,200. So like a $3,500 decrease. Okay.
For the
average price,
it gets blended between the S and the X and everything like that. And there's the semi, which is like hardly anything, but I'm including it here because it'll scale up eventually. So then FSD acceleration.
We're skipping over the semi because it's still de minimis. We think semi. We're skipping over that. Yep. Go on.
Yep. So this gets to total deliveries of 435,000 in this kind of base case, which is maybe a bit on the high side. So maybe do you want to move the base case down to 430, or do you want to leave it at 435?
Well, I thought we were gonna do 440.
Well, I think that was for the upside case. Right?
Oh, okay. So the base case, 430. So we're gonna go over a couple cases here. Okay.
All right. Misunderstood. So let's bring the base case down to 430. So then I won't go through all these details. It's just some small kind of software type upgrades here. I'm assuming a 6% FSD take rate, which is consistent with what I calculated for Q4. So really low. Doesn't have a huge impact here. And then I'm assuming that there is no increase in deferred revenue, full self-driving deferred revenue recognition. And I don't think some people were saying because V11 chip, that'll be a recognition of revenue, but there's no increase in capability as far as I can tell. It's just, they changed the way that they're doing driving on city streets and on the highway. But to me, there's no rationale for recognizing incremental revenue. So I have not assumed anything there. The credits I have increasing to 500 million. Now, this is the, ZEV and kind of traditional auto credits, but you also are starting to get the IRA credits. The biggest component of that's going to be the roughly $45 per kilowatt hour that they get on all of their 4680 cells. But they're also going to get some additional credits for packs that they assemble. That's around $10 a kilowatt hour. Zach Kirkhorn gave some guidance around this, that it's going to be, I think he said, I forget the exact number, but like 200 to $300 million per quarter, or something like that, but increasing over the life of over the course of 2023. So when you combine that figure with the kind of historic level of roughly 300 million or so that they've had from the ZEV credits, I'm assuming $500 million. So I think that's a pretty
$500 million in Q1 of total credits versus Q4. It was 467 million, right?
Yeah,
so
that was all ZEV. Yep,
that was all ZEV. And so this one you're saying ZEV plus the IRA. So the IRA, that's very conservative, right? I mean, just so everyone knows, that seems to be very conservative. That there's only going to be, it seems like the all ZEV with increase in deliveries might be 500 million if it's on par with Q4.
Remember that the rules for recognizing the ZEV credits are like really hard to understand, and they're just lumpy. We don't have a whole lot of visibility. So the
Yeah.
Q4 ZEV credits were much higher than usual. So I think the
Okay.
normal figure has been around 250 million per quarter, maybe 300
Okay.
million per quarter on the ZEV. So if you
Okay.
just assume that that stays roughly flat, you're at 300, and then you add another 200 for the IRA credits. To me, that seems like a
Okay.
reasonable middle ground of 500. So I guess I would be surprised if they were as low as 400 million, and I wouldn't necessarily be surprised if they were at 600 million. So maybe there is some more room for upside there, but to me, it doesn't seem wildly out of sorts. But we can
Okay.
let's leave it here for now, and then maybe on the bull case we can up it a little bit.
Okay.
So then stationary storage deployments. This is a new line that I've added here because it's starting to get a little impactful. So last quarter, they deployed 2.5 gigawatt hours. The storage is by far the biggest chunk of the energy revenue. So by my estimates, last quarter, there was 1.1 billion in storage revenue and only about 200 million of solar revenue. So I'm assuming that's going to continue. Just with the ramp of Lathrop, it's going to have a delay, so it's not necessarily the increase in Lathrop production is what's going to translate to recognition of storage revenue, because there are milestone based payments, and the accounting gets a
Yeah.
little tricky to figure out. But if you assume that there's a modest increase, and not a modest, but a somewhat substantial increase from 2.5 gigawatts to 3.2 gigawatt hours, then I've got the storage revenue increasing about 300 million quarter over quarter, from 1.1 billion to 1.4 billion, and then the overall energy revenue increasing from 1.3 to 1.7. So $400 million increase in energy, and that's going to continue to ramp throughout the course of this year, I think. So putting all this together, you've got 20.7 billion in automotive revenue. You can see that's actually a bit lower than Q4, despite the higher deliveries, and that's due to the lower ASPs.
Yeah.
And then 1.7 in energy revenue, like we said, and then the services revenue just shy of 2 billion. That's been really increasing a lot lately too. Not only do you have the just kind of increased scale of the maintenance and the supercharging and all that, but you also have the used cars coming off lease, which is increasing because you kind of lap these quarters in 2019 and now into 2020, when you're going to have these old Model 3s coming off their first lease that Tesla can then sell and get a profit on. So pretty consistent. I actually didn't notice until just now, but Q4 revenue was 24.3 billion. In Q1, I'm assuming it will be 24.36. So
Yeah.
pretty
So
consistent
almost the
revenue.
same. Yep. Just because the
Um,
main difference is the average selling price of the Model 3 and the Y, right? That's probably the why it's the
yeah.
same, even though there's more units sold, more energy. It's just the price cuts. That is pretty much pure margin the Tesla gave up. Anyway,
Yep.
go on.
Yeah, exactly. So speaking of margin, let's talk about that. So
Yeah.
for those who maybe haven't seen these videos before, I look at the margin in a pretty unique way. I think we try to make an estimate on full self-driving and credits. Well, credits are disclosed, but if you back out your estimates for those items, then you get what I call a core manufacturing margin, which is just if you look at how much they're selling the hardware for and what is the cost associated with making that hardware, what's the margin. So for Q4, I calculated that to be 21.2%. For Q1, I'm assuming that drops to 18%. Now that's for the most part just an impact of the price cuts that we spoke about. But it does assume that there's a $1,300 improvement in cost of goods sold quarter over quarter. So over here, I did a little kind of math, so you can see if the average sale price is $52,000, then your reported gross profit is 21.2. So if you just take that same COGS that's implied from there of 40,000, 41,000 almost, and then you take the 1,300 out of there and you lower the price by 7%, then you can get to an 18% manufacturing margin.
So where'd you
That's
get the
kind of
1,300 from? Is it just estimated, or what? Where did the
yeah. So
1,300
so
come from?
that's my estimate of how much their cost of goods sold will improve this quarter, just based on like Berlin and Austin being at a higher capacity, Shanghai too, although it was clearly down for a bit in
Commodities
Q1.
prices coming back down a little bit.
That's a big one. Yep. So I don't know exactly what it'll be, and we could maybe in a bear case run a sensitivity too, where we assume it will
Yeah.
not be that high. But
Realistically, realistically, your 80% confidence of cost of goods sold decrease could be anywhere from I don't know, I'm just spitballing, like, could be 3,000 to $500 or something. I feel
yeah,
like they at least would have improved by $500, but it could be even 3,000 based on, like, the improvement in automation of Berlin and Austin, for example,
yeah,
being excessive. So it's, that's my spitballing 80% confidence interval. Do you have a stronger
yeah.
or anything? What's
No,
your
I
kind
mean,
of
that
80%?
sounds about right to me. I
Mhm.
would be absolutely shocked if there's not some cost of goods sold improvement.
Yeah.
And like you think of it too, like Austin is really increasing output as well, and you've got the
Yeah.
4680s there, and the structural
Yep.
battery pack, and like
Yeah.
the giga castings, like that. Like the cost to manufacture those has got to be a lot lower. So just
Yeah,
as
and they
that
can
increases as a percentage of the
yeah.
pie, that's got to help. Plus the
And that's
fixed
what
cost absorption.
Yeah, and that's exactly what Tesla was selling. I remember there was that statement from Vivian, the Tesla China executive. I think it was Vivian something. She was in her statement, which if you translate when they cut prices, was like we're passing because they knew they upset a lot of Tesla China buyers that had just bought at the higher price and such. They're just saying like, this is by design. We have improved our costs so that we can lower our prices. So, and I think Tom Zhu or someone else in the U.S. said some similar statement. So Tesla is telling us directly, like, like they are passing these cost savings down to the customer by price cuts. And so if
Yep.
we are to believe them, the cost of goods services should be decreasing significantly.
Yeah, yeah, they should. And just on top of that, the Zach Kirkhorn gave some commentary that he expects it was an answer to one of the questions on the Q4 call that he thinks the gross margins are going to be above 20%. And I forget what the other figure was, but so you can kind of hone in on this. So then even in our worst
Mhm.
case scenario here that we just ran, if there's only $500 of cost of goods sold increase, then you're still at a 20.3% gross margin. So
Yeah.
the way I read his comments is that's sort of a floor. So to me, the 22% seems about right.
Mhm.
22% reported gross margin once you add back in all these other things.
And last
So that
quarter is
gets
25.9. So going from
Yep,
25.9 to 22% automotive gross margin is what we're
yep.
speculating on the base case. Okay.
That's right. Yeah, and there was some deferred FSD revenue recognition in there. So you see it in this row 63, for example, there was 642 million. This is an estimate that I have. Tesla doesn't report it necessarily,
Mhm.
but 642 million of like FSD and other like acceleration boosts, all those things, versus only 366 million. So in Q1, so you are getting hurt from that. But I would say that the 25.9 was maybe helped a little bit by that kind of artificial increase with the deferred revenue recognition.
Okay.
Um, so, anyways, 4.5 billion of total automotive gross margin is what that works out to. Then the energy gross margin, just with greater scale, and the fact that you've got these lower priced mega pack contracts, presumably rolling off the backlog and getting replaced with the higher margin one, because Tesla did increase prices pretty consistently over the past 3 years. So some amount of that will fall to the bottom line and help the gross margins. So I'm assuming the overall the energy gross margin increases from 9.4% to 13.4%. And that equates to roughly another $100 million of margin from energy to 262 million overall.
Mhm.
Um, and then on the services side, I'm assuming just a modest increase from 5.7% to 6.2% margin, and that's 120 million of extra margin there. So, services, I think over time, they've said that they want to get that to 25% or so. I don't. I think that's going to be a kind of slow process, especially when they're ramping up these new superchargers and everything so fast. But we'll see. I'm not assuming anything too crazy for now.
Yeah.
So that gets to overall gross profit of 4.9 billion or 20.2%. And just in the interest of time, I can kind of zoom through
Yeah.
the rest of this pretty quickly because it's less impactful. So $2 billion in total operating costs. And then that gets to $2.7 billion of net income once you take the interest expense and income and all that other stuff out of the equation. Maybe just one quick note on the interest income. I do think that'll increase a bit because the yields have been increasing and Tesla's been investing a little bit more in kind of short dated maturities. So that may be one area that helps. They had 157 million of interest income last quarter, and I have that assuming to increasing to 200 million. But they've got over 20 billion in cash, and they're going to invest a decent amount of that into short-term treasuries, which are getting more and more of a yield. So that may be kind of a dark horse that improves the financials in a non-operating way, but still helps. So that gets to GAAP reported earnings per share of 78 cents. And when you add back the stock-based comp, 91 cents. So I think
last quarter it was $1.07 GAAP and
Yep.
$1.19 adjusted. All right.
Yep.
So this quarter, the base case is 78 cents GAAP and 91 cents adjusted. That's the base case estimate. And most of this is so much lower, even though deliveries we're estimating are going to be higher. It's just a lot lower because, and we think that, cost of goods sold will be decreasing, all those good things, but it's really because of the Tesla price cuts. And they needed the Tesla price cuts. Whatever people think and argue, they needed to do those price cuts to sell this amount of cars, or they could have done some traditional advertising, we suspect, but we will never know. So they cut their prices, their margins by a significant amount. And hopefully their cost of goods, went down somewhat proportionally, because that's sort of the message we were fed by Tesla management.
Yep. So just for some context, the street is at 86 cents right now for Q1. So, we're essentially assuming a 5-cent beat or only 6%. So this is not, an overly bullish case, I don't think. But I do think there's a bit of upside from what Wall Street is expecting. So this is our kind of base case scenario. Do you want to run the bull case, Emmett?
Yeah, very quickly. Just put the 440 in and 440 deliveries, and we'll just kind of zoom to the bottom and see what changes. Yeah.
You don't want to do any gross margin change?
Yeah, cost of goods, maybe make it $2,000 instead of $1,300, or $2,500 instead of $1,300. Yeah.
All right, so then that'd be 20.4% here. So that would certainly be a bull case if they can squeeze that amount out. But so that gets to $1.07 of adjusted EPS, and that'd be a 24% beat. So this, wow. If they did that, I mean, everybody would be forced to increase their earnings targets, because I think the full year 23 earnings per share,
390, right? Something like that.
Yeah, so something like that. It's definitely below $4. So if they do $1 in Q1, and presumably they'll continue to increase volumes and margins will improve over the course of the year, unless they have to do further price cuts. But like that would just force everybody to reevaluate and say, oh shoot, like maybe we need to be at 430 or 450 or something like that. And so then like that would just have a very strong impact if the results were that strong. This is one of the most, I think, impactful quarters that we've seen in a long time, because you're kind of resetting the earnings expectations given the magnitude of the price cuts that they had. So a lot of the Tesla Q are like, oh, they're gonna be breaking even because they don't know how to do math. So they're like, oh, you're giving up like a $10,000 price cut means every single ounce of that comes out of gross margin. It's like, well, no, that's no. But there's
if they go over $1, that would be a nice. That would be very bullish if it's over $1 adjusted earnings per share.
Yeah.
Earnings estimate right now is 91 cents. Stu was mentioning. Yeah, I think that's right. So yeah, over $1 would be great. Last quarter it was $1.19, but the average selling price came down so much that it's going to dip into that significantly, even though there's lots of efficiency improvements otherwise.
Yeah. So anything else with the model, or should we wrap it up there?
I think we'll wrap it up and go to Q&A. I think we have, or is there anything else I want to touch on real quick? We want to leave 15 minutes for Q&A.